Hi, everybody. Welcome to Prince Agency for another installment of our third Thursday community conversation. And tonight, I'm very happy to introduce, we're going to have a gentleman, his name is Ron Cayley. He's a CPA and partner with Sonder CPA, and he's been in the business of tax and advice for more than 20 years. So he's bringing a lot of really great advice to us where it would apply to retiring seniors mostly, or people that are going to be leaving employment and starting their own business and need to buy their own health insurance. So income can affect the cost of health insurance in both of those cases. And at Prince Agency, we're often helping people figure out how to do that most cost effectively, and bringing in tax experts can sometimes be very helpful in planning. So without further ado, we're going to talk about smart tax income strategies. And Ron, thank you. We'll take it away.
Hello, everybody. Nice to meet you all, whether it be virtually or in person. I thought I would do a couple of different things, and I do love questions. I want to make it very interactive. So whether it be again whether it's in person or through the web, so to speak, please do, because I really want to tailor to you. I do have a few talking points. I actually wanted to go over a couple of things that may be a little bit off topic, but won't take very long because it is quite important. For those of you who may own an LLC, as an example, so you form your LLC in the state of Michigan. Doesn't have to be Michigan, but let's just say you did for a second. You may have heard something about the Corporate Transparency Act, which then further reduced to that is the business owner information reporting. It's been an on-again, off-again thing with the Department of Treasury. Their subdivision would be called FinCEN, and whether or not there is certain information that needed to be reported to FinCEN with respect to your ownership in an LLC. It's been, again, off, on. It was put back on again as of yesterday, and we have 30 days now to report that information if we hadn't. Otherwise, it was originally due December 31st, basically, of the year. So I just wanted to bring it up. It's a very, very important part. The penalties are onerous, and if you're a small business, you own rental property, you just have this little LLC you started, and you haven't done much with it, it still can come back and get you, so to speak, if you don't take action. So 30 days from today, I think, is the new filing date. Maybe to be continued. I know there was some legislation going through the House and Senate that would push it off a year, but who knows? So I just wanted to bring that up because it just happened, and it is important. I thought I'd also go over real quickly just some of the sunset provisions that we have within the Tax Cuts and Jobs Act. So that was originally back in 2018, and just things to think about because they do impact your tax return filings. They do impact cash flow, as we'll talk through a little bit more as we get into the presentation. So just a couple of very high levels at the income tax rate. So if we don't, there is the thought that the tax cuts that we're currently enjoying that started back in 2018, will they remain permanent? They're set to sunset after 2025. But whether they do or they don't know. The thought is that they may be made permanent, but again, we don't know. But some things that you may want to consider is tax rates will start to go back up again. So the max rate right now is 37%. Will go to about 40% if we go back to the original. We'll get rid of that big standard deduction in lieu of the lower standard deduction. Back come the personal exemptions. There's the state and local tax cap, which I think a lot of people are probably made aware of, because with that cap, a lot of people now aren't itemizing along with the bigger standard deduction. That may be increased. It may go back to the original. We don't know about that. Also, there is there's what's called a small business for these our partnerships and our S corporations. If we own one, there's a deduction that's called a Section 199A deduction, but that's the qualified business income deduction. That would go away, which then would make owning a flow-through very, very expensive as compared to a traditional entity. So I just want to throw that out there because there is a lot that's going to happen during 2025, and whether or not certain things are made permanent could definitely impact strategies going forward. And I think the key of my session with you all today is really to seek out your advice from your professionals. It's not so much a matter of it's the end of the year, it's December 15th or November 30th, whatever, and you're thinking, oh, I better go ahead and contact. Certainly do that well ahead of time, especially as you're doing other types of planning, like we'll get into, even Medicare planning and that type of thing. So it's all part of it's all the same. The mantra is talk to your advisor sooner rather than later, because it could save you a lot of money for various reasons. What is currently being considered is I mentioned the SALT cap, the state and local tax cap as an itemized deduction. That may go way up depending upon what happens in the House and the Senate. We just don't know. So just a couple things there to go over. One of the things that Melinda and I had talked about is just some tax planning advice for the non-business owner and the business owner. So a person who may be thinking about starting their own, certainly the code and the regulations open up to us as compared to if you're just maybe a W-2 employee, as an example, or you're retired and don't have that business pass-through sort of income, if you will. So some things to think about as a non-business owner, and you want to go ahead and maximize deductions that you may be able to take with respect to your retirement vehicles. So for instance, 401ks, if you are an employee of a company, certainly one of the best strategies for a couple of different reasons is to max it out. So the current max is $23,000. If you're over age 50, it's another $7,000 on top. But the nice thing about the 401ks through your employer is there's typically a match, and that's free money. So remember, and typically, again, the more you contribute, the bigger the match, and the more that you can set aside, which means, again, free money in your hands is worth a lot up front. So the max $23,000 plus another $7,500 if you're over age 50. Whether or not the other would be an IRA. So we have traditional and we have Roth IRAs. With the traditional, of course, as you contribute, you may qualify for a deduction against your gross income as you're preparing your tax return and paying your tax. But with the Roth, the beauty of the Roth is, no, there's not an upfront deduction, but as you take that money out in the future, that money comes out tax-free. So not only the money that you've put in, but also the growth that it's had over the period of time. So there are many clients of mine who started with a traditional IRA, and there's a conversion feature that you can do, which will allow you to go ahead and, yes, you're going to pay some tax at the point in time that you do convert, but you can be strategic about that. So with your advisors, typically there are scenarios that can be run to see whether or not it makes sense based on funds that are in your IRA, what you want to continue to contribute, whether or not we want to go from that traditional to the Roth. And if we say, it looks like it will, based on a lot of different factors, what you think your future tax brackets will look like, just a whole host of things. If it's like, yes, I think the Roth is making a lot of sense, then you can be strategic about that conversion and looking and managing your tax brackets. So for instance, based on your income, the more the income, the higher the bracket you're going to be in. What you can do is try to, if your income is relatively low, as an example, but you're thinking, I want to convert, rather than converting it all at once and maybe going up to the max tax bracket, depending upon how much it is you want to convert, you can say, well, without the conversion, maybe I'm in a 10 or 12% tax bracket. How much room do I have within that 10 or 12% tax bracket? Do I want to go up to the next bracket, which might be 20%, which might mean, well, maybe I can convert anywhere between, let's say, $30,000, $40,000, $50,000, $100,000 and still maintain that certain bracket level that you're willing to, that makes sense versus contribute, maybe doing a $1 million conversion all at once. So I guess the point here is that it's always good to look at what's the period of time that you want to convert. Do you want to convert it all? Okay, let's say we convert it all. Over what period of time do you want to do that to manage the brackets so you can pay the least amount of tax as possible? Another area would be for the non-business, and a lot of this will apply to the business owner as well. But another thing to think about would be maxing out your health savings account. So if you do participate in a high deductible plan, that again is a great vehicle, because whether you're employed or you're not employed, you're just you're employed or doing it maybe through the marketplace plans, the individual plans, you can take a deduction. So let's say you're an employee of a company, and part of that is through payroll deduct, and let's say you do all 7,300 or 7,000 through that. That's great. It's reduced your income. You're not paying tax on it. If there is none, but you want to you're part of a plan, a high deductible plan, there's no type of you haven't done a payroll deduct, the employer isn't doing anything for you, you can still write that check to your HSA provider and take a deduction on your tax return. So the beauty then is, as it comes out, it's not taxable so long as it's used for qualified health and health reimbursement, and the earnings are not subject to tax. So there's kind of a triple benefit there that is referred to sometimes. So by maxing that out, you won't pay tax on that money. It's tax-free. It comes out as you use it. You're not taxed on it. It is not use or lose. So it's yours. You take it. So whether or not you change employers, whatever the case may be, it stays with you and you're able to use it in the future. So again, and if you're over age 50, there's an additional $1,000 that can be contributed to that plan. So that's really good as well. There are in fact, I said that wrong. It's $8,550 is your max plus another $1,000. That's what I was looking at my max for IRAs when I was saying that. So it's $8,550 plus $1,000. Another strategy, if with limitations on our itemized deductions, and if you're if you're of an age to where you're taking required minimum distributions from your IRA as an example, and you want to make those to charity, rather than writing a check and sending it to the charity and taking it as an itemized deduction, you can do what's called a qualified charitable donation right from your IRA. Instead of having to report that income that you would have through the required minimum distribution, that whatever that dollar amount, it's up to $105,000 per person, is what you can actually make a qualified charitable donation during the year. That's the amount. That would not be taxed too. So in other words, if you have a required minimum distribution amount of, let's say $100,000, you go, I want it all to go to my favorite charity, and that $100,000 would not touch your tax return. So it's avoiding the itemized deduction. You're not reporting it as a required minimum distribution because you have donated it. That's somewhat of an extreme example, but I have had a couple of clients who have maxed it out. What I'm talking about here isn't necessarily one of those where you want to come in at the end of the year and do. So in other words, whether it's a qualified charitable donation, whether it's your HSA, I mean, sure, maybe you can't just write the check at the end of the year, but certainly good to start ahead of time, because not only is it in your account earning some, maybe a modest amount of interest, but it's still earning something that's going to be tax-free to you if you need to use it. Cool. Same thing with the IRA. Let me go back a second to that. What we want to think about, it's not too late to contribute to your IRA this year. So if you want for 2024, when I say this year, my head is in 2024 because it's tax time. So when I say this year, I mean 2024. So you have up until April 15th to go ahead and make a donation to your IRA for 2024. So that might be something to where you thought, oh, it's too late. No, it's not too late. It's still something that you would be able to do.
Or even max out HSA contributions for last year if you only put a partial contribution in.
You absolutely can. You have the same date. April 15th would be your date. So whether it's a 401k plan, so it wouldn't be so much the employer match, but it would be your contribution. Still isn't too late. IRA not too late. HSA not too late. You have until April 15th to do that. If you haven't started, well, the other thing I guess I would mention, well, I don't have an IRA. Is it too late for me to contribute for 2024? With an IRA, you can still set the plan up or set the IRA up now and contribute for by April 15th. A little bit different story with pension plans, the 401ks, but with the IRA at least, you can still do that. And so it's really never too late. And if it's something that you've been thinking about doing, you can still do it for 2024, and you have until April 15th, as I've mentioned. Another area that again would be non-business owner, business owner would be marketplace insurance. So I touched on that just a little bit with the high deductible plan and the premium tax credit. So one thing to know about the code and the regulations that we have to work with, they are limited when it comes to the individual versus the individual who owns a business. But there are certain key aspects of the code and regs that do benefit both. And part of those I've gone through just in talking through the HSAs, the 401ks, the IRAs. There are certainly credits that are out there that will assist you in reducing your tax burden. And one of those relates back to, so you're in need of insurance, you're in the marketplace. What we want to think about is the premium tax credit. So that can come to you in one of two ways. It can come to you at the end of the year when you file your tax return, which that's where the true-up is anyway, or it can come to you in a monthly reduction to what you're going to write for the cost of your health insurance, January through December, as an example. The thing to think about with marketplace insurance and the premium tax credit, that one can kind of sneak up on you, and you want to be thinking throughout the year. So let's say, as an example, your income is relatively low when you are initially going through the process of getting the marketplace insurance and determining, well, what is my credit? So if it's relatively low, it could very well be that your credit is going to be very, very high. But now it's the second year, and so whether you're a new business owner, whether maybe that year that you started, it was one of those years to where it was maybe, I'd say, artificially low for whatever reason. But now in year two, your income jumps. Let's say it goes from $40,000 to $100,000, which would be a fairly significant jump. What can happen as part of that is, because your income has gone up, and based on the way the tables work with the premium tax credit, it could very well be that nice credit that you had in year one has now evaporated. And you don't know it if you're not planning for it until you file your tax return, and all of a sudden you have a fairly significant bill associated with that lack of credit, the lack of credit. So that's just what I would recommend doing in those cases, is certainly staying in contact with your providers as you're looking at what is my income going to look like for the next year, to determine what that credit ought to be, and then you adjust whatever your monthly check amount will be, would be one thought. It would certainly be working with and making sure I would hate to see you get blindsided, I guess is what I'm saying, which is usually what happens.
At Prince Agency, we tell people, if you're receiving any tax credit at all, advancement to pay for your premiums, you need to go through an annual re-enrollment in November, so that we are proactively telling the marketplace how much we think you're going to make in the next year, not allowing them to just guess based on a past tax return.
Absolutely.
You artificially end up with taking too much and surprised on the tax return.
And it usually is the surprise that isn't going the one way, it's going the way that you don't really like very well. And I would also mention, you can do your best planning. So you've been proactive, you've reached out, you've done everything that you should do. However, things happen to where all of a sudden there's a windfall of some sort. Maybe there's a new job, maybe there's you're a new business owner and you thought your income was going to be X, but it's a lot higher than X. And as soon as you're looking, we did our planning, we thought our income would be right around, let's say, 100,000, but all of a sudden we're looking at it, no, we're going to be more like 200,000 or 300,000. I would say as soon as you're seeing those, I would definitely reach out and just adjust your premium at that point in time. So that's another thing to think about as well.
The scenario I see often in moving from maybe a small business owner to, say, even an early retiree is they need health insurance and their income's low because they've stopped working, and somebody has a car accident and they need to take $40,000-$50,000 out of their IRA to replace a vehicle, right? And they forgot that that was part of taxable income because they took it out of their IRA. So things like that can happen as well.
It absolutely can. I am aware of a situation to where it wasn't probably the best planning in the world, but it actually happened. In fact, it was fairly poor planning, but there was a money set aside in an IRA, and his daughter was getting married and decided he needed to tap the IRA. He was also marketplace, so his income was somewhat stable throughout, but until he took out his 40, 50 grand, kind of in your scenario, to help pay for the wedding, and all of a sudden his credit had pretty much evaporated. So it can be all sorts of different things, just something you're not even thinking about. What's the big deal? I took money out. Yeah, I know I shouldn't have, but okay, now there's a double whammy to it, sort of speak. You not only have lost your credit, but also you've taken money out of your retirement account. So maybe a little bit ahead of time. So those kinds of things do happen.
One of the biggest places that I see that happen is Roth conversions. Like often people are in those early retirement years and they've taken their 401k money and they've rolled it into an IRA, and their financial advisor is astutely helping them think about, you probably could live to 80, 90 years old and you've got plenty of time to convert money from IRA to Roth. So this growing tax deferred comes out tax free, but and they're often usually working with the tax professional, financial advisor is, and they're paying attention to the tax brackets.
Right.
But they're not necessarily the same income lines as the IRMA, which is income related monthly adjusted amount, where your Medicare premiums go up.
Right.
And it's, you know, husband and wives, they're two separate premiums based on one joint tax return, and both of them get hit. And it's in arrears, so it's like 2 years later.
Right.
So it's another one of those that, you know, by the time it hits your Medicare bill, it's too late to change the tax return. You've already taken the money out of the IRA, and it's, you know, higher.
Absolutely, and that's exactly. I mean, who would think? I mean, you're just doing what you do. I mean, you're surviving. You're doing what you've thought you've been planning. Something like that comes up. You're doing a conversion. All of a sudden, your Medicare premiums go up, and they don't go up by a little bit. They go up by a lot. So that's something else that definitely we want to keep in mind. Just another thing too. It's for the non-business owner. We have, so you've been, let's say, a W-2 wage earner for your entire career. Now you've retired. You have, and maybe you're drawing from a 401k, some sort of pension, maybe an IRA, but you're going now from where there's withholding as part of your salary to something where there is no longer the withholding. And we always want to keep in mind that we don't think about it when we have withholding naturally happening as part of our monthly pay, as an example. But now that we don't have that, we're drawing from. What we want to make sure is that either we're paying in so based on what we think our estimated income is for the year and what tax bracket that we'll be in, we want to make sure that we're either making a quarterly estimated tax payment to cover the income that we have, or withholding through whether it be vehicles such as Social Security, right through the IRA payment. So working with your advisor to make sure you have enough coverage so that when it comes time to file the tax return, a couple things. One is it's not a big surprise that you have this big tax bill due because we haven't done it, excuse me, or we don't have an underpayment penalty. So either way, it's really good to work with just to make sure you've got enough coming out so there's no big surprise. And you never want to pay, my opinion has been, and it just kind of depends where a person's comfort level is, I want to pay in as much as I possibly can without being penalized. That's the way I approach it. Where there are others, it's just a matter of they feel very uncomfortable knowing that they're going to owe something when it comes time to file a tax return. Or they always like to have that little bit of I call it cushion, so that maybe there's a 1,000 or 2,000 that they've overpaid and they're comfortable with that. And that's fine. It's just wherever that level of comfort is. But what you don't want to do is be in a position to where all of a sudden there's a big bill. Where do I get the money from? And now I also have this penalty I need to deal with. So that's something else we want to think about. And that gets into even the cash flow component. Just making sure you're managing that cash flow through, if it's a monthly amount that's just almost, you don't even notice it, so to speak, if that's how you're doing it. Or setting aside money so that when you pay in your quarterly, it's not a matter of, oh, I've got this quarterly to do. So with my business owners, one of the things I tell them to do from the tax side of things, whether the entity that they transact business through is a tax-paying entity or it's a flow-through partnership S corporation, that they have a separate account set up that so on a monthly basis, as they close the books, they go, all right, I know I made 10 grand this month. Okay, your tax bracket is, let's say, 21%. So put away 21% of your 10 grand into this other account. Don't touch it. So now it comes to be your first, second, third, fourth quarterly. The money is there. It's not a matter. And that's just helping to manage the cash flow. Same thing with then the person who's retired. They're taking money from the various pensions. And just to make sure you have enough, it just makes a whole lot more sense. For the business owner, again, I mentioned the code does tend to open up a bit for that business owner. So not only do you have all the benefits that we spoke about above, whether it be contributing to 401k, I mean, one of the beauties, if you have a small business and it's just you as an example, you don't have to, you can do what's called a solo 401k plan. So it's, there's a lot of options to where, you can take advantage of as if you were still maybe doing what you used to before. You were part of this 401k plan. You had it in these investments. Now that I'm by myself, what am I limited to? Well, you're not. You can take advantage of everything that you had before. And one of the very popular things that I see some of my clients who are just the sole proprietors who have their small little S corporation, I should call them, and they set up these solo 401ks, and you can really do well with those. Even thinking about entity types as you're the business owner. So you've started your own thing. What should I do? S corporations are very, very popular. It doesn't mean it's the right one for you. So certainly if it's a little real estate business, or not business, but I own some real estate, I wouldn't put it in an S corporation. I'd leave it probably in a single member LLC. But if you're providing services or you're manufacturing something, whatever, what should I do? How should I do it? Certainly reach out to your tax advisor because they know you and they'll know your situation. But what I do typically see are something in the line of an S corporation, still a very popular vehicle to use. A little bit more off topic, but with regard to the business owner, it'd be a matter of how, I'm buying equipment. What do I do with that? Do I depreciate it? How do I depreciate it? And so there's a lot to that. So depreciation versus expensing of assets, they help, again, manage the cash flow, manage the tax that you're going to be paying as part of that. Cash flow planning, I mentioned earlier with the person who owns the business. If you are that pass-through owner, the S corporation owner, and your bracket is X, make sure you're putting money aside on a monthly basis. That way it's not a matter of, well, I have debt with my business. I've been concentrating on paying down my debt, but I didn't leave anything for tax. Now what do I do? And, well, I better draw from my line, or maybe I don't have a line, so now what am I going to do? And I find that does happen more often than you might think, to where they're making a lot of money, paying down a bunch of debt, but haven't left anything for tax. And so that's one of the things I try to counsel my clients with as well.
I have a thought that comes up there that I've seen a number of times when people are managing income and we're there, and I am not the tax professional, I'm referring them to either their own or making recommendations, but in trying to figure out, is there any way that, once they've had a small business for a while and now it's doing really well and their income is really high, and we're trying to figure out how could we possibly get their taxable income lower so that their cost of health insurance is not so expensive, right? And HSAs are, of course, one of those vehicles, but there's a point at which somebody makes enough money that they can't contribute to an IRA anymore, right, or a Roth. And I've seen so many small business owners, and I don't know that it can be avoided per se, but sometimes knowledge is power. Sure. And often when they're getting started, like you're saying, they're worried about just making the day-to-day happen, and then once they start to make a little bit of money, they're worried about paying off previous debt. And then by the time they're actually making money, they're making enough money they can't contribute.
Right.
Right?
Correct.
So
Correct.
Managing that and continuing to have some of those conversations with your tax professional, I think is paramount, because I see so many people, blow right by it, and the only contribution they can make tax-free is an HSA at that point.
Mm-hmm.
Right? Because
And
there's no limits on those incomes.
Yep, you're absolutely right. And that's where we get into some of the, how does the code open up to you as a business owner, and what can you do? And that's where we get into and trying to manage that income level. And one of the ways that you can manage it would be through, whether you're an equipment intensive business or not, but you still need to buy stuff. You're going to have a computer, a desk, you're going to have certain things. And to make sure that you are taking advantage of, for instance, depreciation. Yes, it is a time value of money proposition, because at some point in time, you're going to dispose of that asset. Maybe you sell it for something, maybe you don't, but it is time value of money. But yet that time value of money can reap dividends, because not only is it reducing your current period income tax, perhaps if you're a small sole proprietor who pays self-employment tax on that money, it reduces that number as well. It gets into then retirement planning and what can I or can't I do. So you're absolutely right. There's a whole host of things that tend to cascade on just that one particular item. Absolutely correct. So that would be just something else to think about in terms of working with how do I minimize? If you are a business owner, if you're incurring expense as it relates to the operation of your business, well, there's a very high degree of, it's more likely than not, you're going to be able to take that as a deduction to reduce the income that you're pulling in. I can't say everything is, but most everything is. There are certainly some limitations. For instance, if you get into things like club dues and meals, entertainment is not deductible. So there's always something. But in general, to operate your business, that's all reducing to get to your bottom line. So you always want to take advantage of that and make sure that you're working with your professional, and again, seeing them ahead of time so that you can structure. I can tell you just from experience that what we do try to do is, for sure, we touch base at the end of the year. So we'll certainly want to do that, but it's not so much the touching the base at the end of the year necessarily to talk about the end of the year. That is part of it. It's already planning for the next year. And that gives some room in order to think about things like whether you are Medicare planning, whether you are 401k planning, whether you are, you're doing that ahead of time versus, well, now it's December 15, and I'm still looking at 2024. December, and I'm looking at my 2024 operations. There's really a limited amount of items. It's really limited what you can do because you haven't planned for. So again, I can't stress enough to just continue to work with and be open and talk with. Not everybody wants to do that, and that's fine, but certainly that's what we're here for. We're here to help you, and so want to make sure that we're always taking advantage of that expertise.
Yeah, I have a thought on people who are buying their own individual coverage, like starting a new business as an example. I have a lot of people that come into my office, and they're very focused on those deductions that they can take as a business owner to reduce the amount of taxes that they have to pay on that income and so forth. And one of the things that they're often tempted to do is they want to pay for their individual health insurance with business funds. And I have to deliver what sounds like bad news to begin with, that you can't pay for an individual policy with business funds. You have to pay for an individual policy with private funds, right?
That's correct.
But as a self-employed person, you correct me if I'm wrong here, you can deduct it on your personal tax return.
You are correct.
And
That
even,
is the beauty.
even though you're
Yes.
not itemizing, right?
Correct. Yes.
Yeah, so you can take a deduction for that. And so, and then I've had a couple of other people that we used a strategy with their tax professionals' help to say, you know, you could take a tax credit throughout the year each month to help pay for your health insurance up front. And then, you know, you're probably going to about, you know, we're fairly sure you're going to make X amount of dollars this year, right? Because maybe you have a couple of years of history. And they want to take a tax credit throughout the year. And I suggest, well, you might want to talk with your tax professional, because if the cash flow allows, if you pay for your premiums up front, you have more to deduct from your personal return. And then you get, if your income is the same amount at the end of the year, which actually would probably be less because you're paying for your health insurance,
Right.
then you also get the tax credit back on your tax return, and you get the benefit of both, rather than taking the tax credit up front throughout the year. It's not always cash flow, you know, people aren't always able to take advantage of that.
Sure.
But with proper planning, again, like you're saying, if we're usually looking a year ahead, where you're looking a year back, we're meeting with people in November talking about the year that comes, and we have to try to help them estimate what they're going to make in the next year. So we're often pointing them towards their tax professional and saying, ask these questions, see if this would work for you, right?
To be as proactive as you possibly can with everybody, including the tax professional. I mean, some things just happen and you deal with it, but just in general, when you're looking at how you can take advantage of the code, in my case, the code and regulations, it takes time to plan a strategy. You mentioned the health insurance, so going back to the individual and the Form 1040 that one would file, there are the itemized deductions that we've alluded to. And most people that I see nowadays, because the standard deduction is so high, aren't itemizing. So what's on the itemized deduction schedule? Well, you have the medical component, so it would be the insurance, it would be bills that you incur from doctor, hospital, that kind of thing. That has a limitation. So we call it an AGI limitation. You have to have so much, 7.5% of AGI in order even to take adjusted gross income to even take a medical insurance or medical deduction, not insurance, medical deduction. Then you have state and local tax. We said, well, that's limited nowadays to $10,000. That might be changing. I don't know. Then you have charitable contributions, and we live in a very generous area, and I see where there are many who do contribute significant dollars to charity, typically, and then you would have things like mortgage interest. So those are the components of your itemized deductions. And in reality, without either significant medical expenses or a person who's very charitable in their giving, everybody's defaulting to the standard deduction. So going back to your health insurance deduction point, you're absolutely, one of the ways that you can avoid then, so you can take advantage of, is if you are self-employed. So what that would basically mean is a person who is a sole proprietor, they can take a deduction for, we call it for AGI, meaning reducing adjusted gross income, avoiding the itemized deduction. So otherwise it may be trapped and you never get any sort of deduction. You have, so the sole proprietor, you have a greater than 2% shareholder in an S corporation, and you have partners in a partnership, all of which would qualify then for this what we call self-employed health insurance deduction. So it's very, very powerful, and that's where the business owner can take advantage of, where if I'm, now granted, if I'm an employee and I'm covered by health insurance, well, you can't beat that. That's fantastic. But if I'm self-employed in one aspect or another, how do I make the code work for me? And this is one of the ways that you can do it. And then in addition to, of course, your health insurance, your HSAs.
I had a gentleman this past November that was in this exact situation, and he'd been in a copay plan before where he could not make a contribution to a health savings account. And the cost of health insurance through the marketplace went up substantially over this past enrollment season. And he was really in a dilemma as to whether or not he was considering going without health insurance altogether because he just, quote, couldn't afford it. And by the time we put together pay up front for it, take the deduction for it, get the full tax credit on your tax return, and contribute to an HSA and get that tax deduction, it almost 100% paid his premiums for the year.
Oh, no kidding.
Yeah,
Wow.
so it
Okay.
can be very powerful if the planning is done well and ahead of time.
No, that's again, I said the mantra would be talk to your professional, and those are reasons why you want to do it. You can't do all that in the last couple of days of a tax year. There's just no way to do it, not even feasible. One of the, I was going to say, one of the other areas is, now I haven't seen this very often, but it is an issue that can come up from time to time, which would be those who might otherwise qualify for Medicare A and B. If you, of course, are on Medicare, I'll call it, then there is no HSA deduction for you. You can't do it. Now, granted, if you've had one that's built up over time prior to where you've gone on to Medicare, Medicare period, A or B or both, you can use it. Not to say you can't use it, but you can't contribute to it because you're no longer in it. It would not be a qualifying plan. So there could be, keep in mind that if you are on Medicare, you can no longer contribute to your HSA. The other side of it is, and I don't know if there's a point to where you can say, maybe I don't want to take, I can, but I don't want to take advantage of Medicare A and B. So is there a reason, and I'm, again, never run the numbers, but if you want, if it's a matter of contributing to the HSA, being on a high deductible healthcare plan, and does it make more sense for you based on credits and such versus, being on Medicare? I don't know, but
The only way that would be possible is if they have a large group plan, which is 21 or more employees on the plan. They can stay on an employer HSA plan. If it's 20 or less, they can't do that.
They can't do
but
that. Okay.
but absolutely, I have people that say, I want to take advantage of contribute as much as I possibly can to the HSA before I actually retire. My wife is 3 years younger. I'm going to work till I'm 70.
Right.
I'm going to stay on an HSA, not enroll in A and B, and fully contribute. Yeah.
fair enough. And at the point in time, so let's say you do it mid-year, you've been on, so you switch over to Medicare, let's say in July 1. You can contribute up to through June 30, so you get a prorated deduction is how that works. So I've had a couple questions that have come up. Can I still max out even though I've gone on Medicare during the year? And the answer is no, it's prorated. So that's just something else that you may want to think about. It's a great question, and you might automatically think, well, why can't I do that? I was on a high deductible plan, and I'm contributing to my HSA. Why shouldn't I? But unfortunately, there is a proration rule that is there.
Yeah, the government won't let you double dip. Take
No double
subsidized Medicare and tax deductions for HSA contribution at the same time.
Correct. And most of this is always stay tuned. That's the way it is. But who knows what goes on with Medicare in the future as well. I've been reading some things. You have to be careful with what you read. And it's always changing, and but anyway, so it's always a stay tuned, stay in touch with your advisor, because that's the way it is. I don't see any reason that I see it's nothing like that I would think would change in the immediate future, but still always good to keep in mind because things are evolving all the time.
We have somebody online that's asking if we could get something that's printable that we could email them.
Absolutely. So I do apologize for that. I have one right here for you.
That's all right. You just scan that you got, and
Well,
And we'll email it.
we'll be happy to do that. So there, no problem. You'll have my bullet points that I'm talking from. It'll give you some of the key dollar amounts that I've referred to, whether it be the maxing the 401k or the HSA, and whether you're under or over 50, I've got the catch-ups as they're referred to. So absolutely can.
Yeah, great.
And Ron, did you want to speak to the type of clientele that you can help with?
from your firm? Like who's a key client that would really benefit from your services?
Absolutely. So the easiest way I'd want to say it is we're always happy to help those who value the services that we offer. So in other words, I wouldn't ever tell. I would say I'm welcome. In fact, I do. I'll talk to anybody just to see if I can help them, and it would be a matter of based on their current situation, whether or not it does it make sense for us to get involved, not involved. But our typical, I would say we're probably about 40% where they're just their clients and they're 1040 only clients. We have the other 60% who are business owners, and we do their 1040s. We do high net worth clientele, and we do others that are not high net worth clientele. It's just more a matter of we don't do a lot of 1040s as an example where it's just a W-2 and maybe some interest. Probably doesn't make a whole lot of sense, but for sure, I mean anybody I can be of service to, I'm happy to, and I would just leave it at that. Yeah.
Absolutely. And we'll post your contact information for you and your firm in the comments for this event as well.
I'm just confused, maybe a simplified version of the difference between a simple IRA and 401k.
So the simple plans are what I'd call kind of boilerplate plans, and they have features. And so not an expert when it comes to the various plan documents, but I would say this: the simple versus even like let's say even a solo 401k or something like that would be is they have it defines when a person can participate in the plan, which is pretty much from the immediacy. And then it also says, for instance, what's the contribution amount? So usually there's a mandatory contribution by the employer of 3%. So that's what I normally see. It's more of it's very simplified. We're going to partake in, we're going to contribute 3% to your retirement account, and then you can choose how much you want to defer. I mean, that's a very high level answer, but that would be how I would say it.
And how would you say a 401k would be different?
401k would be different from the standpoint of there are different plan features that a employer can provide to you. So that there isn't with the simple, there is a mandatory 3%, where with an employer provided, it can be, where I came from, they match 100%. So talk about free money.
Wow.
Yeah, I mean, they contributed 100%. And I would practically go borrow money if I had to, I mean, to do that. So you have that flexibility with like a 401k to where you wouldn't have it with a simple plan. Flexibility, yes. And again, for the small business owner, I would definitely think very seriously about something like a solo 401k. I mean, they're features.
When you say solo, do you mean it's for the owner only?
Yeah, mini 401k. Yeah, so for instance, if it is an owner only and they're going, well, what type of plan can I have as in one person shop? Well, they can open what's called, it's been called solo, it's been called mini 401k, but it's meant for the very small, the individual. And, I think it can extend to family, but don't quote me on that. I think for sure spouse. I don't remember about extended family, but it is something that is out there for and can allow somebody to defer quite a bit of income by using.
I've heard, I could be wrong, that daycare is tax deductible.
There is a credit for daycare, but like anything else, what you get is the percentage that you get or the amount that you would get is based on income. Your overall, it's probably based on, everything seems to be based on modified AGI, modified adjusted gross income, which is where you add back things like your non-taxable component of Social Security if you have that kind of income, if you have tax exempt interest, excluded foreign income, those kinds of things. But to answer your question, there wouldn't be a deduction, but there would be a tax credit available.
Okay, and does that also apply for preschool?
It wouldn't necessarily be for preschool. it's child. So it's meant for like the easiest way is like daycare. So you go to your child goes to daycare, or you have somebody watching your child. It could even be an in-home nanny for that matter. So but it wouldn't be like for preschool. But I would say if it can be if it's part of, yes, we're watching your child, as compared to they're going to preschool. I mean, I know they're watching your child when they're in preschool, but there is a distinction that can be drawn. And normally when you have the child, the credit you're referring to, it's when, let's say it's a two-wage earner household, mom and dad, as an example, are both at their respective jobs for the day, and child goes to daycare is really what that's meant for.
So even if it's like a family friend that you pay, let's say $50 per day to, you can still get that credit?
Family friend, what you would need to do is probably provide that person with a 1099 that show, so it's getting, what you need to think about is, so on the form that you would have when you're taking that credit, it's going to say, well, to whom and what's their social security number. So yes, if it's going to a family friend that you're paying to do that, you've got her social, you said, okay, we've paid you 10 grand during the year, whatever that number is. Yes, you would be able to take that. You'd be able to use that as part of the credit. Yes.
Even if they're not an accredited daycare?
You don't have to be accredited, to my knowledge. It would just be more a matter of making sure that you have the tax information, so that, meaning the person, the address, and the social, in order to take that credit. So I don't think I've never seen anything about accredited daycare. No.
Thank you again,
Thank you very
Ron. We appreciate so much your coming out and helping us. And look for us to post this on our website probably within about a month. We polish it up, put some titles on it, add his bullet pointed list in the mix there, and education. Thank you. Take care. Until next time.